Mr. Xing, Morgan Stanley highlights that large U.S. fiscal deficits are crowding out global capital spending. So how do you assess the broader financial risks posed by this debt trajectory?
Thank you for having me here. Good question. The U.S. fiscal deficit could expand by another $300 billion this year. But more importantly, it's about its long-term trajectory. If current budget proposals at the Congress level in the U.S. were to become permanent, what does that mean? That means they could add an additional $15 trillion to the national debt in the U.S. over the next 30 years, over and above what was expected to happen per the market. If you, based on the analysis from Yale University or other independent research places, this significantly increased government borrowing in the U.S., and that could also raise interest rates if current proposals become permanent. Recall that, before all these tariff announcements dominating the market debates over the last 2 months, it was the issue of interest rates and the government borrowing that had the market attention back in January. And then as of today, you have already seen the market reaction. This 30-year perspective that is under the most scrutiny by the market. U.S. 30-year government bond yield briefly touched 5% on January 14th. And then over the last 2 weeks, it returned there quite recently. So this represents some of the highest years for long-term U.S. borrowing, saying maybe in the last 2 decades. Those higher years represent higher costs. And ultimately, these will become higher cost for borrowing for U.S. corporates as well. And of course, if you can earn 5% return long-term from U.S. Treasury, how does this impact the return you require to invest in other areas in the U.S. Over the longer run? For example, U.S. equities or office building, those same high yields representing higher cost for almost everything. So I do think what you asked was an extremely important question. And it's not just about this year, this keep expanding of fiscal deficit in the US. It's about this long-term trajectory if current budget proposal in the US became permanent.
Mr. Xing, so as tariffs drive inflation higher, the Federal Reserve is expected to keep interest rates unchanged throughout 2025. So do you see monetary policy increasingly constrained by trade-related price pressures?
Yes, that's a great question. In fact, we were probably the one and only investment institutions that expected the Federal Reserve to keep interest rates unchanged throughout 2025. A few months ago, a lot of people in the market were expecting aggressive rate cuts, but we think there will be some inflationary pressures driven by tariffs. And the first decision to maintain the current interest rate levels is influenced partially by the anticipation of that tariff-induced inflation. Despite it could be transitory, the Fed is quite cautious about its persistence of inflation, which could complicate their policy decisions. Therefore, while the Fed is not immediately constrained by trade-related price pressures due to its view that inflation could be temporary, I think they are also trying to be very cautious on cutting the policy rates even before the tariff impact starts showing data. But if you think about the tariff, eventually it will create a downside for the economy's growth because corporates will take a pause on capex with these trade uncertainties. Consumers will probably spend less. What does that mean? That means that despite the near-term inflationary impact from tariffs, eventually U.S. economic growth could decelerate with tariff impact. That's why, while we are not expecting any rate cut for this year, we think the Fed will start cutting rates in every single FOMC meeting starting March 2026. So next year, the US is likely to cut rates by an accumulative maybe 170 basis points for next year. That's our view on the Fed rate trajectory, which is near term, inflationary pressure due to tariffs. But over the medium term, you will see more economic downside created by the tariff uncertainty, and the Fed will cope that with the monetary easing next year.